Hi there, welcome to Kneppy Invest and welcome to another portfolio and technical update where I look at the performance of my three personal portfolios, and I thought I might also have a look at the performance of the group portfolio, which I haven't done for maybe a month or so. And the last bit of today's video, we'll do a bit of a technical update looking at about 17 individual companies charts. Also have a look at commodities and the XJO and the NASDAQ, which I seem to do every single week. But starting with the group portfolio. So about, was it 2.5 years ago, I asked viewers of this channel to give me a few companies they thought would outperform the market over the next 5 years. And we are almost halfway through this particular project. And unfortunately, the group portfolio is down on a per annum basis, 18.8% versus the benchmark, which is up 4.14%. The other thing I just did is I had a look at the capital gains for companies within this portfolio. And the only company with a positive capital gain was Unity Group, but that company is no longer on the ASX. It was bought out. That capital gain was 20%. There is no other companies within the group portfolio that has a positive capital gain. Now, quite a few companies have a positive net return because when you include dividends, and some of these companies have fairly big dividends, including Fortescue, BHP. Probably wouldn't say Woolworths has a pretty big dividend, only 4.1% dividends over the past 2 years. But when you add dividends, only 4 companies have a positive return. Fortescue at 10.8%, BHP 8.6%, Woolworths 3.2%, and Soul Pattinson 1.5%. Now, the biggest problem about the group portfolio is too many story stocks, because we started this little project during the, I wouldn't say bubble period, but during a time when interest rates weren't rising. They were still fairly low, and a lot of these story stocks were still quite popular. So if you look at the worst performing companies within the group portfolio, we have Zip, Aries Resources, which is not a story stock. They've just performed really badly. In fact, down 59%. Imogen Biosystems, Pointerra, our Sit-in, Province Resources, Email Payments making their way back. That's not a story stock. That's just circumstances. Well, not circumstances. They made an acquisition of an Irish something or other, and then the bank or the Central Bank of Ireland said, we're concerned about money laundering, and there were some issues with that. Vonex, BrainChip, definitely 2 story stocks, even though Vonex has a little bit of revenue. Dust Group, Central Intelligence, Kogan. Now, some of these companies are starting to turn around, in particularly Kogan, Email Payments, definitely not Lake Resources. Tezzeret started, the share price started to go up. Megaport definitely on the rebound. A2 Milk still going down. ResMed has had a bit of a troubled period over the past a month or so, and I think that's looking really cheap right now. And Xero has turned around significantly as well. And CSL, which is down 4%, that is at the bottom of its range. In fact, CSL right now is looking attractive simply because of that. So overall, just because the makeup of this particular portfolio, too many story stocks in it, and that's why it's down. Now, if you look at the history of this, at one point in time, April of 2022, it was up 16%. In fact, at one point in time, the group portfolio was up 25%. And main reason it was up 25% was because of Lake Resources and Vonex. Both of those companies were up big, and they're down big since then. Again, both of those companies are story stocks, and story stocks have really suffered over the past 2 years. Now into my own personal portfolios, and I've been using ShareSite. Well, I've been using ShareSite for a long time, but I've been tracking the performance of my 3 portfolios since the start of this financial year. And apparently I have to renew my ShareSite subscription. I got an email recently, and so I'm going to have to pay a little bit of money for that. Anyway, so I have 3 portfolios: long-term, medium-term, short-term, using different strategies. So long-term portfolio is the quintessential, or using the quintessential investing strategy of buying companies for the long term, quality companies for the long term, and just holding on to them as long as possible. Most investors get taught that, if you do get taught anything at all. So if you listen to podcasts and that sort of thing, this is the favored investing strategy. In fact, there's a few experts I listen to who will buy a company and not sell it at all. Their whole philosophy is you don't sell it, you just keep on holding. I don't really like that sort of strategy. But anyway, this is the strategy I used when I started investing, and I'm still using it. I do have some questions about it, whether it does suit my own personality. And yeah, and I just wanted to see and break down the performance of this particular strategy versus some other strategies I am using. So at this point in time, it's not performing as well as I would like. In fact, it is down 0.16%. Now, it is beating the benchmark, but only slightly. So say it's sort of even. And in fact, because I do have holdings in international indices, there is a currency gain at the moment, and that has actually propped up my returns. But saying that, the benchmark did have a dividend, so the STW, a 2% dividend. So in fact, the benchmark in terms of dividends is beating my portfolio. Capital gains, long-term down 2.16%, and the benchmark down 2.27%. So both of these, the long-term portfolio and the benchmark, performing fairly similar. When you look at the best performing companies within this particular portfolio, PWR Holdings, Pro Medicus, which is an absolutely brilliant week. It's significantly, well, I wouldn't say significantly overvalued, but there is definitely a premium for that company. You do have to pay for it. Nick Scali, Domino's Pizzas, and Baylor Tech, 5 best performing companies in terms of percentage return. Worst performing companies, Clinuvel, which I almost sold a few weeks ago, and the share price has fallen a fair bit. And I think there could be some value in that company right now. WiseTech, ResMed, Nanosonics, and CSL. I'm thinking of trading CSL and possibly even ResMed a little bit further because the share prices have dropped, where I think there is some value. Internationally, worst performing company is Shopify, and then Volkswagen. We also have Taiwan Semiconductor Manufacturing down a bit. And the best performing company internationally is Alphabet, followed closely by Adobe. I have not actually bought a company listed on international exchange for a long time. I have been thinking about it, but I haven't actually hit the button, the buy button. Anyway, so slightly disappointed with the performance of the long-term portfolio. The other thing to notice here is you can break down the performance of each grouping. So you group it into different indices. For instance, ASX, NASDAQ, and also New York Stock Exchange, and also whichever exchange the Volkswagen was. And it says FRA, which I think would be France, but I thought it was I thought the Dutch. What's the German index called? The DAX. Anyway, and if you do break it down, in fact, the best performing group is ASX. In fact, if I was just investing ASX, I would be up about 1.6%. So my ASX, maybe I should just keep investing just in ASX. That's it. But I do think it's quite healthy to be exposed internationally, and that's what I'm trying to do with this group portfolio. Now, in saying that, when I look at my other two portfolios, the medium term and short term, I only invest on the ASX, and both of these portfolios are performing absolutely outstanding. So maybe these sort of strategies are what I'm suited to. Now, the medium term portfolio is just buying, I'd say, I'll call it smaller companies that are not high quality just yet, have the potential to become high quality in the future. And I actually do really like investing in this space. And we have seen some companies give back significant returns. So at this point in time, this portfolio is up 7.3%. Also get some good dividends as well. That's the other thing I should mention. Some nice dividends here. So this portfolio up 7.33% compared to the benchmark, down 0.23%. So I have to be happy with that. And so the capital gain, actually overall return, is above $10,000, which is really nice for the period of time we're talking about. Best performing companies within this, Energy One, which I sold out because there was a takeover bid for that company. I decided to take profits. Still up in there whether this takeover bid will go through. And if it doesn't, I might buy back in Energy One. There's no reason to buy just yet. Email payments, as I've mentioned before, has performed really well. A surprising positive financial year result, beat expectations. Share price of that company has rallied, and my return on that company is up 88%. Doug Tech, Ansarada, Audinate have all performed very well. Those 5 best performing companies. Coming in number 6 is a company I bought recently, Atlas Pearls, up 36% since I bought. And I will show you the chart of that company, potentially taking profits with that because share price has run up a lot. And then we have EZZ Life Science, Aussie Broadband, Playside Studios, Johns Lyng Group, Crisis Corp, and Tyro Payments. So a few companies there, particularly John Lyng's Group and Ordinate, are 2 companies I might transition to my long-term portfolio. The other thing I should mention is just because a company right now is in one of these portfolios doesn't mean I won't move it to another portfolio because my opinion on that company could change. And I do think Ordinate and Johns Lyng Group might be considered high-quality companies fairly soon. Worst performing companies in this particular portfolio. So you notice I have a lot of holdings in this portfolio. So I don't listen to those who say you should only have 20, 25 holdings. It's ridiculous because most companies in this particular portfolio have a market cap well below $1 billion. So not much of them ASX. So if you just think of this as an index here, well, maybe that's not the right way to put it. The makeup of this portfolio, individual companies in this portfolio make up a very small part of the ASX, probably less than 1%. So even if the ASX goes up, doesn't mean this portfolio will go up with it. In fact, we've seen that because this portfolio has significantly outperformed the market and because they're all very small companies compared to the banks, BHP, and all those sort of companies. So I don't believe that you have to restrict yourself to only 20, 25 holdings. Particularly if you only like smaller companies. Now, the worst performing companies in this list is Xtek. I'll show you the chart of that. Someone did request that. I think that company is particularly looking really cheap right now. I'm not sure why the market has sold off. Ventura Health, Frontier Digital, LGI, and Satire are the 5 worst performing companies. But you can see the worst performing company is only down 25%. And if you look at the best performing companies, we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 companies that have performed better than the worst performing company. And that is the benefits of buying into these sort of companies, particularly if you do a good job of selecting which companies to invest in. And that's the reason why this portfolio is significantly outperforming the benchmark, because I've made some good decisions. Some good decisions, some bad decisions as well, but it's okay. You're never going to make 100% good decisions. So we're very happy with the performance of this portfolio. Maybe I should just stick to investing in smaller companies and just ignore those high quality companies. Now onto my short-term portfolio. So this is using a technical analysis strategy. And I really wanted to see how well I can perform. And to be honest with you, I have made way more mistakes using this strategy than my other medium-term strategy. Yet I am actually outperforming my medium-term strategy. So at this point in time, this portfolio is up 10.12%. So significantly outperforming the benchmark. And it's significantly outperforming that. Best performing company, you can see returns here not as much as not as high as my medium-term because I will take profits. I'm not scared to take profits in this portfolio. At this point in time, in fact, what I'll do is I will only show you my open positions. So I don't have many positions right now. A couple of mistakes I have made. ResMed, I was a little bit too quick taking a position in ResMed, but I am trading that right now. And I would expect that company's share price to not get any lower than, say, $20. Integrated Research, I'm actually thinking about adding to my position that. And maybe I'll show you the chart on that company if I can remember. Best performing companies that I still maintain a position in, Megaport, Email Payments, both above 30%. Now, one of my goals in this was to take profits if the share price gets to between 30 and 40% higher than when I bought in. So both these companies I could take profits in, but I think there is potential share price could run further from here. Step 1, ServiceStream, MA Offshore, all above 10% at this point in time. Now, funny enough, I did only make one buy during the week in all 3 portfolios. That was a company called Mader Group, and that was in my short-term portfolio. So you might notice here, Mader Group is not listed here. So if I go to the closed positions, Mader Group is listed down here. So I'm no longer holding it, but I've got a 6.3% return. In fact, I bought and sold Mader Group within 1 day. I bought it at, was at the close of trading one day, and then I sold it within a few hours of trading the next day, and the share price rose 6.3%. and I just had to sell out because I was a little bit skeptical about my decision to buy in. And then I thought 6.3% return in less one day was good enough for me. And I'll show you the chart for Meta Group and talk about why I decided to take profits in that company. So overall, this strategy is performing probably better than I expected, particularly because of the mistakes I have made. I've made quite a few mistakes. And the best thing about making mistakes is, well, the only reason or way mistakes can be beneficial is if you learn from it. And I am learning from some mistakes I am making. Anyway, really happy with the performance of two of my portfolios, disappointed with my long-term portfolio. And fun enough, that is a sort of strategy you will be told is the only strategy that works. I have been hearing this a lot from experts. That's the only strategy that works. It's bogus. There's many strategies that work. And the reason why a lot of experts say that's the only strategy that works is because Warren Buffett uses that strategy. And he's been successful only because he's been investing he's still investing. If he stopped investing when the typical person retires, he wouldn't be as highly thought of as he is. Anyway, and the other thing is his returns on a yearly basis, probably 20%, maybe just less than 20%. And people think they can, if they use his sort of strategies, they can sort of get returns that he gets. And I think that's ridiculous. And in fact, many private investors get much better returns than Warren Buffett. And he makes a lot of mistakes. And his investing teams make a lot of mistakes. And they're not as nimble as some other big investors, is my opinion. That's just my opinion. I think he's a little bit overrated. He's a great investor for the long term, but he's a little bit overrated. In my opinion, there are some experts, Phil Town is one of them, I believe have shrines. And Phil Town says there's only one way to invest. That's the way I invest. All other ways are bogus. And one of the reasons I don't listen to him anymore. Anyway, rant over. Now on to some charts. So how many charts we can look at today? 28 charts. Geez. So the first two charts we're going to look at are the indices, and the XJO is trying to stay above the sort of the support level. Support zone, we call it. The support zone is between about, we'll call it 6,900 and 7,000. Whenever the XJO has fallen into this or very close to this support zone, we've seen it rally. It's done it 1, 2, 3 times in the past, actually 4 times now, because it fell below 7,000 for a very brief period of time a few days ago. In fact, what day was that? That was the Friday, 22nd of September. Well, that's right. That was a really big rally day. And we've seen the XJO just stay above that during the past week. Was it a down week? I think it was a down week. So another down week, only down 0.3%, but overall, again, nothing's changed with the XJO. It's going sideways. Sideways moving indice. Nothing to be excited about. The only reason I would get excited is if we see it fall below 6,900. That would be really bearish. And then if it fell below the lows we saw back in June last year, so 6,400, that would be really, really bearish. And the only way I would be bullish is if it got above, say, if it got above 7,600, I would be excited then. And eventually it's going to get above 7,600. Eventually it will, without doubt. I can guarantee you, 100%. The XJO will eventually get above 7,600. It may never fall below 6,400 because over time, indices go up. The great thing about equity markets, they go up over time. Some people don't understand that. NASDAQ, not as bullish as it was between March and, say, July, and then NASDAQ was in a beautiful uptrend. Right now, this is starting to look a little bit more bearish, but the uptrend has not been broken. But the recent lows we have seen, which was on Wednesday, 27th September, were lower than the previous low, which was the 18th of August. So possible lower low. We also have seen a lower high. So one lower low, one lower high, which is the possible start of a new downtrend in the NASDAQ. That's what I want to talk about when it comes to the NASDAQ and the XJO. Now to some commodities. We've got about 6 commodities here. And then we're going to look at the bonds. I haven't been looking at the bonds for a while. And I was surprised when I looked at the bond charts. So I was quite a bit shocked. I'll talk about why in a second. First one is iron ore. So iron ore looks okay. Not as good as uranium, not as good as US oil, but not as bad as lithium, and nowhere near as bad as gold. But iron ore looks okay. It's holding up. And if iron ore prices stay around these levels, $120 or so, that would be okay for my one iron ore company I am holding right now, which is Mount Gibson. And possibly I'm thinking of taking in another position in Phoenix Resources because the share price has fallen. If it fell below 20 cents, I might think about adding buying into Phoenix. But anyway, iron ore is holding up quite well, but not as good as uranium. Have to look at the weekly chart here. You've got uranium just keeps every week. It's now 3 big weeks in a row. In fact, when you look at the weekly chart, it's had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 12 up weeks in a row. 12 up weeks in a row. Eventually, we should see the uranium prices pull back a little bit, just like we have seen in the past when it's rallied. We've seen 1, 2, 3 rallies in the past, and we saw the uranium prices pull back a little bit. So at this point in time, I'd be hesitant buying uranium companies just because of my expectations of a pullback. But who knows? It could keep on rallying from here. So one of the things you could do is just take a small nibble in uranium company or uranium ETF, something like that. And that's on the possibility of uranium prices keep on rallying from here. But again, don't be shocked if you see a little bit of a retracement back in uranium prices. And if it gets back to $60, that would be very healthy. Or even $55, that would be very healthy. Oil looks actually quite good. Well, it has been looking good. If we look at the daily chart, weekly chart looks better as well, but the daily chart looks pretty nice. A nice pullback in the price of oil the last 2 days, but that's okay because the previous day to that was a really nice rally. But this is an uptrend. So US oil is on the up. And I will show you one oil company, Karoon, because that looks pretty good as well. Lithium. Notice here, lithium 1-day price down 6.5. So let's have a look at the weekly chart for lithium, and it looks really ugly. So complete reversal to uranium. Remember, uranium had seen 12 weeks or 12 up weeks. Uranium has now seen lithium has now seen 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 down weeks in a row. And just like uranium, I would be not surprised to see a bounce. We saw one bounce back in May, and wouldn't be surprised to see another bounce. Yeah, I don't have any lithium companies apart from maybe Mineral Resources, but that's more diversified holding. And the main reason I don't hold lithium right now is because of this particular chart. It looks really negative. What looks also negative is gold in the past week. In fact, in the past week, gold has fallen almost 4%. And you can see that on the daily chart. It's just fallen like a rock the last 4 or 5 days. And I wasn't overly negative bearish on gold leading up to the start of this week, but this looks way more bearish. Last time gold prices were this low was back in March. So we are talking about a 6-month low in gold prices. And again, gold has been trading in a range, and the bottom of that range is 1620. And that was last reached in October, November last year. So it's possible it could get back down to those levels. I just don't know. But at this point in time, gold is looking way more bearish. Funny enough, we do not see significant reactions in gold prices on Australian companies in the past week mirroring gold prices. So maybe Australian dollar went down. I have no idea. I don't really follow currencies that much, by the way. That's why I said that. I have no idea what happened with the Australian dollar. But just based off the gold companies' charts, we didn't see much of negative reaction. Next one is coal. So we did see coal go through a bit of a downtrend. Possible bottom has been reached at about 120, and now it's possibly going up. So a little bit more bullish on a coal right now. And there were a couple of coal companies' charts I did look at, which went, that looks interesting. Now onto some bonds. And we'll start with the Australian 10-year because this is the first one I looked at. And I went, whoa, it's a breakout. This is a classic breakout. And breakout happened on the 21st of September. So this is the first time I've taken notice. So you can see I don't look at these charts all the time. And the main reason I was surprised is because around 4.3% was a pretty good support level. Now there is arguments that said the more times the price of something touches a support or resistance level, the weaker that support or resistance level gets. Now, there's two ways to look at it, and it comes back to psychology. If the individual trader sees a price of a company gets to a certain point over and over again, they are more willing and more likely to sell or buy at that level. But then, as you go through time, the more times it hits that level, those who are willing to sell out or buy in lose. Well, you lose those sort of investors, and that's why you might see a breakout. So possibly that's what happens with this. Well, not more likely happen with individual companies, if that makes sense. But government bonds, the Australian 10-year government bond yield was having problems getting above 4.3%. You can see it got to 4.3% in June last year, hit it again in October, hit it again in July this year, and again in August. You can see every single time it got to 4.3%, it retraced. Now, the last two retracements were not quite as far as or long as the ones we saw in 2022, and then we saw it just break out on strength on the 21st of September and has risen since then, up to 4.5%. Surprising. So then I had a look at the other bond yield timing thingies. This is the 30-year US government bond yield, and that broke out as well. And that broke out probably, you could say, either the 20th or the 21st. Now up to 4.7%, which means, and there are Treasury bond ETFs, and one of them is the TLT. And if I was to play a retracement in bond yields, which is a possibility over the next few years, particularly if we move into a significant recession, more than likely I will play the TLT. And the TLT is at a really good support level. If we look at the weekly chart for the TLT, the last time it was at down these levels was not 5 years ago, it was actually 10 years ago, 12 years ago, back in 2011. So this is the lowest the TLT has been for 12 years. You can just see it drop like a rock. So this will mirror bond yields because, again, don't forget, bond yields and bond prices are inversely related. So the time to buy this particular ETF is when bond yields are dropping, not when they're rising. So that's all I got for bonds and commodities. Let's have a look at individual charts. I'm pretty sure I showed you CSL chart last week, and I am interested in taking a position in this company simply because where the share price is right now compared to historical levels, and the share price level between 240 and 250 for this company has been a good buying price over the past 3 years. So we can have seen it 1, 2, 3 times in the past when the share price got below 250. You could even say 260 is a good time to buy. So I'm waiting for it to get below 250. It did fall below 250 for a very brief period, but I just want to see it sustained. When I say for a very brief period, if we look at, let's say, the 15-minute chart, there it is. 11 o'clock a.m. on Wednesday, 27th of September, fell below 250 for a very brief period of time, say about, say, maybe 1 or 2 hours. But the 15-minute chart looks fairly bearish. Daily chart looks really bearish, but just because the share price is right at a sort of a good buying level is the only reason I am thinking about taking or trading this company. I have a long-term position in CSL, and the upside, if you do look at the weekly chart here and look at the where the share price might end up. So whenever the share price gets above, say, $310, that is a time to think about maybe taking your profits. So that's a 25% upside from $250. That's a nice little profit if you can take it with CSL. And the way I'm trading, or you think of CSL, is a long-term position, and then I will trade CSL, just like I will trade every single company. Meta Group. So this was a beautiful chart, beautiful daily chart. And then the share price fell in 2 consecutive days, 10.1% and then 7.8% on Thursday and Friday of last week. I think I'm pretty sure I mentioned Meta Group. And then the share price rallied. If you have a look at the 15-minute chart, actually, we'll have a look at the 5-minute chart. 5-minute chart. maybe the week, maybe the hourly chart. No, have a look at the 15-minute chart. All right. So the low point in Meta Group share price was on Monday, the first, we'll say first 5 minutes or 15 minutes of trading on Monday. And then the share price went sideways for the rest of the day. That was a good sign that selling has come to completion. We saw a lot of selling on the Friday of last week in the first 15 minutes. So possible capitulation. And then when I saw the share price rally on the Tuesday, I bought in on open on Tuesday at $6.17. And the share price did bounce pretty strongly on some pretty good volume, but not as good volume as we saw on the previous days. The volume there was much higher. And then the share price moved above $6.60. And then we started to see the selling really lighten off, which was actually a bad sign. That means those who saw value in Meta Group were no longer there, and they had already bought in. And the demand for Meta shares was less than the supply. We started to see supply come onto the market, and that's why the share price is starting to go down again. And that was my signal to sell. So I sold out about, I think it was about $6.60, I think it was. So a nice profit with Meta Group, and I sold out on Wednesday morning. Actually, I can't remember. Yeah, it would have been Wednesday morning because I had to take my car. I did an emergency shift at work on Tuesday night, had to take my car for a service, and then I had to wait for like an hour. I went for a run as my car was being serviced, and then it took a little bit longer than I expected, the car being serviced. And then I had to wait around for maybe an hour, and then I sold Meta Group in that hour because the share price had pulled back in the first few hours. I thought, now to take profit. So held Meta Group for 1 hour, or 1 day. Yeah, almost exactly 1 day. And I'm very happy with the 6% return in 1 day. And I'm even more happy because the share price has pulled back again. And you can see on the Friday, there was a share price actually opened up. It opened at $6.64, and there was a lot of selling that came in that first hour. Not a lot of volume, but still the share price retraced from there. So I'm not sure what's happening with Meta Group, why the share price dove in those 2 trading days. And the bounce we did see was short-lived, and it was fairly weak. So at this point in time, I'm not sure which way the share price will go. If the share price fell below about $5.40, that would be very bearish. But maybe the uptrend in Meta Group has come to an end, and that 2-day capitulation we saw, maybe not capitulation, that 2 days of selling we saw on Thursday, Friday of last week was the end to Meta Group's uptrend. Now to Xtek. So someone did request to me have a look at this because the share price did bounce it's bounced nicely off about 27 cents. Share price is still in a downtrend. Share price moved in a downtrend. The sign was the 27th of February when they released their results. Share price down 18% on that day on high volume. That was a time to sell. I should have just listened to the chart and went, should sell right now, because the share price has or is now in a downtrend. The thing about Xtek, and the reason I'm still having a position, the market cap of this company is $32 million, $89 million of revenue in last year, $6 million of profit. So the PE ratio of this company is 5. The market's just really wary about the future performance of this company. They announced another contract the other day, and I think the market is overreacting. And when I do see the market overreact, or possibly overact like it has with Xtek, and the problem with Xtek is there's no recurring revenue. The financial performance of this company has to do with getting new contracts, new deals, that sort of thing. And there's a lot of investors, a lot of experts who don't like that sort of business model. I have no problem with that business model because a lot of these companies keep renewing contracts. They keep selling their products, that sort of thing. You don't need recurring revenue to be successful. And I think the market is simply not really understanding the future potential of Xtek. So a nice little bounce in the last few days. It's not the end of the downtrend because the share price had been sold off significantly leading up to this nice little bounce. So that's all it is. It's a bounce at this point in time. But I think there is possible value with this company. Right, now to a nice little purchase I did make, and that's Atlas Pearls. So I did have a look at their financial year results, and I went, wow, is this company really cheap? So For those who haven't watched that video, revenue $27 million, profit of $9 million, and the market cap of this company was something like 20 million, or maybe just above 20 million. I went, something's wrong here. If the market doesn't understand this company, the market doesn't know this company exists, or there's really good value right now. So I thought I'd just take a very small position in Atlas Pearls, and the share price, I think it was 5.7 cents, and around about here, 12th or something of September. The chart looks really good at that point. Share price was going sideways, not a lot of selling, and then for some reason the share price has really taken off in the past week. In fact, the share price, look, the weekly chart, has risen in the past week. It rose 30% in 1 week. Now, whenever I see a share price rise 30% in 1 week, I do become a little bit wary. Not massive volume, that's the other problem. Not really big volume. So I am thinking of maybe taking profits. But in saying that, I have a small holding. So profits, if I took profits, we're only talking about a very small, in dollar terms, very small profit. So I think my position now as Pearls was only $1,000. So we're talking about 30% rise. We're talking about $300 profit. And I'm not sure if I'm willing to do that right now. But I don't know. I'm torn on this one. I just don't like that sort of chart when the share price has just taken off 30% in 1 week on no significant news. But again, it could be just the market saying, or participants in the market looking at Atlas Pearls and going, there might be some value here. And it's all about risk reward. Is that the best way to say it? Risk reward. It's asymmetric at this point in time. It's all swayed to the reward. The risk on this company are fairly low at this point in time, particularly when you look at valuation. There's probably a better way to say it. Anyway, so Atlas Pearls, that was a good decision I made over a week ago. And my question is whether I should take profits. Who knows? I just wish I took a bigger holding. Say if I took a $5,000 holding, I would definitely take profits. I wouldn't sell out completely, but a 30% rise on 5,000 would be 1,500 return, and I'd definitely like to take some of that off the table. Core Lithium, I saw the share price of this company rise 19% in 1 day, and I was like, oh, what's happening here? Then I saw a suggestion that the company released their full-year results. They did not. They just released their annual report, but there was high volume as well. So I don't know what happened. They released no price-sensitive information. They released a media release talking about how they were profitable and their annual report. Now, I just don't like the reasoning from some experts why the share price rose 19%. There's something else happening there. It could be just a bounce because when you look at the daily chart, the share price has fallen a lot over the past few months. And it could be just a bounce. But the volume is surprising, really high volume. Highest volume we've seen since November last year. Now, this is not a breakout at all, just because the share price has fallen a lot over the past few months. And again, I think this is just a little bit of a bounce. Market cap of this company is still $865 million. Profit of $10 million. According to TradingView. Whether that's right or wrong, who knows? Star Entertainment Group. So this is one of the mistakes I made in regards to my short-term portfolio. This is one of the mistakes I made. I took a position on this company on the 11th of August after the company released some positive news. Now, my mistake here is when you look at the chart, that was not a breakout. There was not even any potential breakout because even though share price rose 18% on the day, there was so much resistance because the share price has fallen a lot. There is going to be a lot of supply coming into the market. Those shareholders who bought at high prices will want to sell shares, and there wasn't enough demand for shares. And that was pretty obvious, particularly if you look maybe 1 hour chart. It's pretty obvious when the high in the share price was in that first hour, and then the share price just kept on dropping, and it's just plummeted ever since. And then you can see massive volume coming in on the Wednesday. Company has done a capital raising. The share price fell 10.9% in the first hour. On that day, the share price fell 13.6%. And I think the company is now healthier because of this capital raising. But yeah, this chart looks really negative. I mean, one way to play this is the capital raising, and possibly this is the last capital raising they'll need to do, and this could be the low point. I could actually listen to the argument that this is the low point for Star Entertainment Group at 61 cents. market cap 1.6 billion. Seems a lot, but if you look at the long-term history of this company, the sentiment in Star Entertainment Group has never been lower. Look at the long-term chart going all the way back to 2011. Share price has not even been close to this low. The lowest it was previous to this was back during the COVID-19 financial panic. The share price got to $1.40. Now, there's more shares on issue now, but the share price has never been lower. Share price has been as high as $5.80 back in February 2018. Could that be the sort of the highs you might expect in the future around this company? Eventually, potentially, the sentiment in casinos will change to be more positive. And so I could definitely see some value in this company right now. This could be the low point for Star Entertainment Group. City Chic. Well, look, this is the Matador signal, my Kneppy Invest Matador signal. This is sort of the chart you see in a lot of tech companies over the past few years. Share price rising a lot and then falling a lot. So City Chic. Oh, why did I include City? Oh, share price increased 16.9% on Friday. No reason to get excited about that. We have seen significant rises in the past for this company. In fact, on the 4th of August, share price rose 28%. On the 27th of July, it rose 13.8%, then 6.6% the next day. On the 30th of June, it rose 15.2%. On the 31st of March, 16.13%. On the 19th of January, 2023, 16.4%. Yeah. So even though share price rose 16.9% one day, I don't get excited about that. And the other thing is really low volume. The only reason I think it did rise like that, it was on low volume, and the share price, I think, possibly has reached a bottom, and that bottom is around about 31 cents or so. And those were the lows we saw back in June and July of this year. To be fair with you, not interested in City Chic just yet. I need to see some change in sentiment, change in the trend of the share price. But I think the only reason I included City Chic in this list today is just the share price did increase 16.9% in one day, but that does not mean there's a change in trend and a change in sentiment of the company, as shown by all those previous days we've seen in 2023, where the share price has risen by above 50% in one day. It happens quite a bit for this company. Now onto one REIT. This is the first REIT I looked at. Still remember looking at it and going, oh, that's interesting. Dexus Convenience Retail. And I've noticed a lot of REITs share prices have dropped a lot in the past 2 weeks. And in fact, the drop in share prices of these REITs mirror the rise in bond yields. That should be not a shock. There should be a relationship between REITs, or the share price of REITs, and bond yields. So another way to play decreasing bond yields in the future, apart from that EDF I showed you, is REITs. I'm not a big fan of REITs overall, and if I did have a pick of REITs, I wouldn't be against this REIT, but more than likely industrial REITs. Not interested in retail REITs. Not interested at all in office REITs, unless I think the market is overreacting. So this is one of the reasons why a lot of REITs share prices have dropped a lot over the past few weeks, and Dexus Convenience Retail is one of them. What's the other one? Charter Hall Long REIT. This collapsed. Look at that. It's just bad results as well, and this is just looks awful at the point in time. And more than likely, these REITs are trading at a significant discount to the NTA, and all that is saying is the market expects the assets of these companies to be brought down, to be revalued downwards by a significant amount. That doesn't mean there's value in these REITs, because there's a potential revalue of their assets. And now, Nine Entertainment Group. Why Nine Entertainment Group? So look at the chart for this company. So this is the daily chart going back to July last year. And one of the things I always look for is share prices of companies consolidating, going sideways over long periods of time. And usually if a company's share price is consolidating, it's usually trading in a range. And that's exactly what Nine Entertainment Group is doing right now. It's trading in a range between $2.20 and $1.85, give or take 5 or 10 cents here and there. You can see whenever share price gets to $2.20, it's happened 4 times in the past year and a bit. It's pulled back. And when the share price gets to, say, $1.85 or near there, we see the share price rally. But you'll notice the two moving average ribbons I have here have been coming together. Another way to look at that, what's the thing called? I just totally forget what it's called. I don't use it all that much. What's it called? The not Fibonacci, the Bollinger Bands. So I don't use Bollinger Bands because I don't really need to. But if you were looking at Bollinger Bands, you'll probably see with 9 Entertainment Group, the Bollinger Bands are squeezing together. Can't even describe what. Let's put Bollinger Bands on here if I can. Bollinger Bands. Got to spell it right. Well, that is right. Oh, I know. I need to get rid of one of my. Okay. Anyway, but if you were looking at Bollinger Bands, you probably notice the Bollinger Bands are squeezing right now, which means there's less volatility. That's the way to look at Bollinger Bands. When they squeeze or come together, there's less volatility. And typically, if there's lower volatility, eventually you're going to see increasing volatility, and that's when the share price breaks out to the upside or downside. And that's what I'll be looking for with 9 Entertainment Group. A breakout above $2.20, bullish breakout, and a negative breakout would be share price getting below $1.85. So I actually have put 9 Entertainment Group onto my watch list because it is looking interesting right now. The share price is coming together. The volatility is becoming less and less. The moving average ribbons are coming together. And that is telling me right now that eventually we're going to see a breakout in 9 Entertainment Group. Just the direction of that breakout is undecided right now. Bega Group, surprised this. I don't follow Bega Group all that closely. Well, they're called Bega Cheese. They do own Vegemite now, which is really good. But this looks really bad. And then I looked at the weekly chart. And the last time the share price was this low for Bega Cheese was way back in 2013. Not only that, if you go back to 2013, this is look at the weekly chart now, there's a nice little, we could say support level at $2.50. You can see the share price get above $2.50 and then pull back, test it, and then pull higher. And then what is the share price right now for Bega Group or Bega Cheese? Share price for Bega Cheese right now is around about $2.50. So it's right on that support level. So I have not done any research on this company. And so if you just look at the quick metrics or quick financials of this company, markup 766 million, revenue last year 3.4 billion, not profitable. So revenue consistently above $2 million, but this company has really low margins, so really low profit. Dividend yield 3%. So the market is really pessimistic about Bega Cheese right now. Possible buy just because of where the share price is in relation to historical levels. And the upside is pretty big. So not long ago, well, 2018, I suppose that's 5 years ago, the share price got as high as $8. Don't think the share price will get that high, but who knows? The only oil company I'm going to include in today's chart, even though oil prices look pretty good, is Karoon Energy. Karoon Energy looks pretty good. Nice little breakout. And the reason that breakout occurred, just put a chart line here. So why am I putting a line there? You can see the share price on 1, 2, 3, 4, 5 occasions got to this level and pulled back. So what you'd be looking for is a breakout above $2.40. It occurred about a month ago, 31st of August, and then it tested it on 2 occasions. So that was the time to buy, either that day or that day. So last time to buy this was the 21st of September, and the share price had pulled back or pulled it higher. And the share price now at, say, $2.64 is, I'm going to say maybe last time share price was this high was back in 2015. So the weekly chart looks nice. The daily chart looks nice. I should have been following this a little bit more closely because I probably would have taken a position in this company at about $2.45 or $2.50. So Karoon Energy, possible buy. I'm going to put that onto my everyday list. There are some companies I just look at every single day when the market closes. I just have a look at the chart every single day. Should have put Karoon Energy onto that list. 6 companies go. APA Group. This is an infrastructure company. I don't like infrastructure companies. I've never liked Transurban, never liked Sydney Airport. I don't like these sort of companies for some reason. It's just me. And these, probably a way to say it, I've heard this a few times, these are bond proxies or something like that. So those who should invest in bonds more likely invest in these sort of companies, infrastructure companies. But because they're bond proxies and bond prices have been going down, not up, what's been happening with APA Group? Share price has been going down. Not only that, the share price right now, $8.30, is right on and pretty good support level, because the last time two times we've seen share price of this company get to these levels was the low. So that was back in the COVID-19 financial panic, and then again in October of last year. And share price has collapsed over the past 2 months down to $8.30. So even though I am not the sort of investor who would buy into APA Group, the whole point of me doing these videos is to share ideas with you. So possible idea for you and your portfolio is APA Group. TPC Consolidated, sort of a wholesale energy company, which I have held in the past. Oh, there already, I've got it here, buy, sold half. I did include where I sold the second half, but so wholesale energy companies have performed really well. And I think the reason why I decided to follow this a little bit closely, share price rallied a lot. From the 28th of August to the 21st of September, the share price of this company went from $4.20 to $7.60. And then in 2 trading days, the share price of this company fell 5% and then 21.8% on the 25th of September. Not sure what happened on that day. There was pretty big volume. Whether it's just someone taking profits, I don't know. And the share price has pulled back to $5.26. So this is a possible sneaky buy the dip situation for TPC Consolidated. For those who don't know, this is a very small cap company. Market cap is $60 million, yet this company produced $137 million of revenue in financial year 23 and $17 million of profit. So the PE ratio of this company is 3.5, dividend yield 7.6. So even though the share price is significantly higher from when I bought, there is some value. Probably should never have sold out of this company because there is some value. Traditionally, this company has been illiquidly traded. Liquidity has improved, but not quite as much as what you want. So possible value. I'm not the biggest fan of wholesale energy, but there is times when this company will perform really well, and financial year 23 was one of those years. So Lease is a company. It's in my buildings materials. I think it's called buildings. It's in my buildings watch list. And I've noticed a lot of the building companies, we're talking about James Hardie, Boral, ABC Brighton, or Brighton, what's it called? Adbury now. A lot of these companies' share price has pulled back over the past month. So I had a look at Lease, and Lease is really interesting right now because it's at a nice little support level, $7. Again, I'm not the biggest fan of this company. Doesn't perform that well. And I'd only trade this company, potential just a buy the bounce situation for Lease. And Brickworks released their results over the week. And based off the reaction and the volume, the market didn't like the results, not only Brickworks, but also Soul Pattinson. So Brickworks and Soul Pattinson released their results together because there's this cross-ownership between the two. And I think they did this cross-ownership back in the 70s, might have the wrong decade. And the whole reason they did this cross-ownership is so the other one couldn't be bought out, which makes sense. But I don't think you can do that anymore. Anyway, this company released their results, and there was a really negative reaction just by looking at look at the 15. No, we look at the 5-minute chart. So they released their results on Thursday, and look at the share price, just plummeted. Share price went from about $25.70 down to a low of $22.80. I wasn't really following Brickworks much at this point in time. I'm pretty big volume, but a nice bounce. So there was probably an overreaction from the market, and there was a pretty nice bounce. So I'm going to have a look at the results from Brickworks. I did have a very quick look at the results of Soul Pattinson because I thought their results will be absolutely stellar because they do hold New Hope, and I thought the dividends they got from New Hope would be spectacular. But when I had a very quick glance at Soul Pattinson, on first glance, and that was a very short glance, it didn't look that as good as I thought it was going to be. And you can see Soul Pattinson share price took a massive plunge as well. A little bit more long-lasting than Brickworks, but nice little bounce as well. And if you have a look at the daily chart forward, yeah, so market didn't like the results for these two companies. Now to a company I might do a standalone video on, just because I've never looked at Proteomics International. Their share price rose 23.3% on the Friday on huge volume. When I say huge volume, I'm talking about huge volume. We're talking about over 1 million shares traded, when previous day, we're talking about less than 100,000 shares traded. Yeah, so huge volume. I did not look at why the share price rose by a lot, but and if this was a breakout, I probably would have had a closer look at the reasons behind it. More than likely, it was some positive news. I don't even know what this company does. Let's have a look at what this company does. Market cap of this company is 136 million. So this company is a medical technology company which operates at the forefront of predictive diagnostics and bioanalytical services. The company was founded in 2001 and is headquartered in Perth. So it doesn't really tell me what they do, but some good news on Friday. So the share price rallied, but the only problem I have is the share price was at these levels back in May and also in January and February this year. So there is a little bit of resistance moving forward. And that's why we did see some selling during the day. So share price got as high as $1.17, which was the highs we saw back in January. Technical analysis does work. So those shareholders who bought back in January this year saw the opportunity to sell. So they added their supply of shares to the market, and that's why the share price fell, because of added supply by those shareholders who consider this company dog stock because the share price fell from when they bought. It's all about psychology of investors. Psychologists, or not psychologists, investors want the share price of the company they buy to increase immediately. If it doesn't, they think the company's a dog stock. Simple as that. I've heard this quite often. Last company I want to look at is Vonex Limited. I don't follow this company at all. Ticker code VN8. So this company is in one of my portfolios. In fact, you can tell by this. It's in my Appendix 4C portfolio or watch list. And I don't go through that watch list all that often. Look at the share price. Horrible chart. Share price got as high as 32 cents back in the start of 2021. Share price moved into a downtrend in April 2021. So it's been a downtrend for almost 2.5 years. Share price has fallen during that downtrend from 15 cents to a current share price of 1.3 cents. So I just had and because I saw the chart, I went, oh, this looks ugly, 1.3 cents. Market cap, $4.7 million. Then I had a look at their financial results and I went, ooh, this could become interesting. Revenue, $45 million. Says loss of $22.8 million. Company was EBITDA positive, $5 million. Free cash, not free cash. Operating cash flow positive, $2.5 million. And they would have been free cash flow positive as well. They did make an acquisition. So there is possible arguments that the market is completely overreacting to this company. Now, they're a telecommunications company, engages in development of new technologies in the communication industry. Its business unit is comprised of Vonex Wholesale, Vonex Telecom, and Development Engineering Department. The Vonex Wholesale unit provides PBX endpoints, voice minutes, and advanced PBX features. Another reason I know this company is I transitioned moved from TPG to more telecom when I changed or moved into NBN. NBN fiber to the premises. TPG did not provide me any services. So I had to move to another provider, and the best deal for me was more telecom. And there is a relationship between more and Vonex, and that's another reason why I had a look at this company. And so Vonex is looking interesting. The chart looks absolutely horrible though. So I think the only way the sentiment in this company will change is if we start to see interest rates decrease significantly, or the company just shows the market they can become profitable on a sustaining basis, on a consistent basis. So I have now put Vonex, actually I haven't yet, I've now put Vonex onto my, maybe not everyday lists. I'm going to put it onto my turnaround. I look at my turnaround watch list a little bit more than my Appendix 4C, because on my Appendix 4C, I have 133 companies in that watch list. In my IPO watch list, I have 143 companies in that. So those are the two portfolios I look at much less than others. Some of the other portfolio or watch lists I have as little as 10 companies in them. High quality one, I have only 6 companies in that at the moment. Anyway, that's all I've got for this particular video, technical and portfolio update. If you have any questions, any thoughts, just leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good weekend. And it's a long weekend for those in New South Wales and Queensland. So the market is not open on Monday. So have a great long weekend.